Hello and welcome everyone to the fourth lecture in the Global Lecture Series. The objective of this series, organized by Jindal Global Business School, is to bring in experts from all over the world to discuss cutting-edge research in economics and business. Today, we have with us Professor Julieta Yung, Assistant Professor Economics from Bates College, Maine, USA. And the lecture topic today is, can interest rate factors explain exchange rate fluctuations? Professor Yung joined Bates College in 2017, and she has served on the Consensus Economic Forecasting Commission for the state of Maine since 2019. She works as an ad hoc consultant for the Bank of England and the Bilateral Assistance and Capacity Building for Central Banks program. Professor Yung's primary research fields are macrofinance and asset pricing, with a focus on modeling yield curves, global networks, and exchange rates. Prior to Bates, she worked as a research economist in the international group of the Federal Reserve Bank of Dallas. Professor Yung holds an MA and PhD in economics from the University of Notre Dame. Before we begin, here are some housekeeping rules. First, please keep your mic and webcams turned off at all the times. At the end of the lecture, we will take the questions. In the meantime, if you have any question, you are more than welcome to type them in the chat box or in the Q&A box. With that, it's now over to you, Professor Yung.
Thank you. So I'm going to go ahead and share my screen. And if you all can see it, then I'm going to get started. Okay, so thank you very much for this invitation. I wish it could be in person, but I'm very grateful to the school for putting together this global lecture series and keeping us connected during these times. My name is Julieta Yung, and my research agenda seeks to understand asset markets. So bond markets, foreign exchange, commodities, equity markets. And in particular, I'm interested in understanding what are the drivers behind fluctuations in asset prices, and also how are these asset markets interconnected, and what is their role in the transmission of shocks onto other markets, as well as the macroeconomy. So in this paper in particular, I focus on the relationship between interest rates and exchange rates. And the motivation for this paper comes from the idea that interest rates measure the amount of risk in the economy. So as the yield curve moves, that risk is being priced in there. And if we are able to understand bond risk premium movements and capture that risk, then we should be able to understand movements in other asset markets. And in particular, I'm going to be looking at the exchange rate market. So let me give you some preview of what we already know about the importance of interest rates in determining things about the macroeconomy and other financial assets. First of all, we have understood that there is a relationship between interest rates and the macroeconomy. So for example, here in the US, if we look at the yield curve and we see the yield curve invert, or the long-term end of the yield curve go below the short-term end of the yield curve, we are likely to see a recession in the future. And this is the best known predictor of recessions that we have to date. So interest rates are already providing us really valuable information about economic activity in the country. And if we look at nominal versus real interest rates, for example, we can extract information about expected inflation. Interest rates have also been linked at stock returns. So if we want to know how expected future cash flows are being evaluated for equity markets, we want to look at interest rates and also expected interest rates in the future. And if we look at interest rates in different currencies, this is known as the uncovered interest parity equation. We should be able to understand exchange rate movements, even though the data suggests that this relationship is not as straightforward as looking at interest rates in both countries because of the presence of time variation in risk premium. So the general idea is that, when investors are deciding how to put their money on the line, they're thinking about many things. One of those is the risk profile, like different risk assets. How risk averse are they? They will also be looking at assets in different currencies, and they will also be considering investments at different horizons depending on their preferences. So intuitively, what this means is that there is a unique pricing mechanism that is pricing all these assets simultaneously, given information that we have at time t. So in this question, in this paper, I'm going to ask a specific question. Can the same factors that are driving movements in the yield curve, movements in interest rates, also explain movements in the exchange rate? So the first question is, okay, what are interest rate factors? And with this, you should be able to see right now the picture of the US yield curve from 1975 all the way to 2016. And in this yield curve, we can see that interest rates move a lot over time. And this three-dimensional picture shows us what interest rates are at the 3-month, 6-month, 1 year, all the way to 10 years. Now, in normal times, we know that the yield curve tends to be upward sloping. That means that interest rates at a short horizon tend to be lower than interest rates at a longer horizon. Now, there are a couple features from the US yield curve that stand out. The first one is that interest rates move a lot, especially at the short end of the yield curve. And we can see that after the 2008 global financial crisis, the short end of the yield curve dropped all the way to what we call the zero lower bound and remained for almost a decade in there until December 2015, when the Fed started normalizing interest rates and increasing the short end of the yield curve. Now, this picture is not showing what has happened in recent years, but if you have been following bond markets, you might already know that the Fed continued its normalization policy, and during the COVID uh, 2020 recession, interest rates dropped to the zero lower bound again. Another aspect of interest rates that stand out is the long end of the yield curve that we see when we look at the 10-year yield over here. And this feature of interest rates suggests that the long-term end of the yield curve has been declining for many decades now. And this is not unique to the United States. We see many other advanced economies that are also experiencing this downward pressure on yields in the long end of the yield curve. Now, this is presenting some interesting challenges in terms of movements in the over time and movements in the cross section, because the lower the long end of the yield curve is, the more likely we are to see yield curve inversions, because it's not that unthinkable to look at a yield curve inversion when long end of the yield curve is so low to begin with. So these are interest rates, and as you can see, there is a lot of movement and rich dynamics that capture very valuable information. But how do we use this information? And this is where interest rate factors are going to come into the picture, because interest rate factors are variables extracted from the yield curve by principal component analysis. And principal component analysis is the eigenvector eigenvalue decomposition of the variance covariance matrix of the yield. So in essence, how can we summarize most or the majority of this movement cross-sectionally in the yield curve by only having like 1, 2, 3 variables as opposed to this entire set of movements? So let me show you what these interest rate factors look like, and we have them here in panel A. I extracted 3 factors from the yield curve. The first one is in blue. It's called the first factor, and we can see that it moves a lot quite a bit, and it captures most of the movement in that entire 3D yield curve picture that I showed. So we have over here that for this particular time period, this one variable alone, this blue factor alone, can capture more than 97% of all the cross-sectional variation in the yield curve. Now, if we keep extracting variables from the yield curve, like the second one in orange or the third one in yellow, then we keep explaining movements, but of course, we're explaining less and less movements since the first one already captures so much of this cross-sectional variation. So overall, these three first factors combined account for more than 99% of the cross-sectional movement of the yield curve. And you can see how appealing this is econometrically, because instead of having multiple variables, we can just look at these three variables alone and be able to understand most of these movements. Now, on panel B, we have what is called the factor loadings, and this is how much weight does each factor place on the yield curve at different maturities. So for example, in blue, we have the weight that the first factor plays on the yield curve from 3 months all the way to 10 years. And you can see that this is a relatively flat line around 0.3. And what this means is that shocks to this first variable, to this first factor, are going to impact all the yields in that yield curve roughly equal. So if there are shocks to this factor, the yield curve is either going to go up entirely or down entirely. And this is why the first factor is typically called the level factor, which is a label assigned by Letterman and Shakeman in 1991 when they started studying these principal components from the yield curve. Now, what about the second factor? Well, the second factor in orange shows that the second principal component from the yield curve loads positively on the short end of the yield curve, more than 0.4, but negatively on the long end of the yield curve. So now shocks to this factor are going to pull the ends of the yield curve in opposite directions, thus changing the slope of the yield curve and inheriting that name. And finally, in yellow, we have the curvature factor that loads positively on the ends of the yield curve, but negatively in the middle of the yield curve. So shocks to this factor are going to change the concavity of that yield curve. So now that we have our interest rate factors for the US, I want to show you that we can do this for many other countries, and these are the countries that I'm going to be looking at for this particular paper. We have advanced economies, and one of the takeaways is that we can extract the principal components or the interest rate factors from every country's yield curve. And these three first factors combined are going to account for the majority of the movements in each one of these bond markets. So for this presentation, I'm going to give you an overview of how we model yield curves using a term structural model of interest rates and how we estimate this yield curve. So we're going to use these three factors to learn how to estimate yield curves. Now, this is well known in the finance literature, but what I'm going to do that's different, I'm going to model two yield curves simultaneously, and I'm also at the same time going to model the exchange rate between those two using this term structure model. So let's push this term structure model, this yield curve model, and see if it can inform us about exchange rate movements as well. Then we're going to discuss the results. I'm going to show you the British pound and US dollar exchange rate as an example, and then an overview of what happens for other currencies as well. And I'm going to talk specifically about forecasting out of sample and how can we use the information that we have today about yield curve movements to think about the future of the exchange rate. And finally, I want to show you an application of what happens when the yield curves move. How do they impact the exchange rate? And one of the takeaways from here is that nonlinearities are going to be key to understanding how movements in the yield curve will impact that foreign exchange market. So the model that I use is officially called a Gaussian dynamic no arbitrage term structure model, and I'm going to use the Jocelyn, Singleton, and Su estimation method, which looks at this model in discrete time. Now, what is the main goal of a term structure model? Is to explain these cross-sectional movements in the yield curve. Now I'm going to be pushing this model further to ask not only explain the cross-sectional variation of yields in two different countries, but also explain the exchange rate movements between them. The key assumption of these models, which is very standard in the finance literature, is that there are no arbitrage opportunities in each country's bond markets. And I'm going to be making some assumptions for econometric tractability so that we can have the simplest possible model, and then we can think about how can we make the model more sophisticated and slightly more difficult in different dimensions. So the first one is that we have a small number of observable risk factors. And you know what this will be. These are my interest rate factors. So this is going to be the risk in the model. It's going to be captured in the yield curve. And because we have two countries, each country is going to have their level, their slope, and their curvature. And that's the only source of risk that I'm going to have in this model. I'm not going to add anything else. Now, the next assumption is that yields are modeled as linear functions of the factors. And because the factors are observable and because the yields or the yield curve will be a linear function directly related to these factors, then I will obtain closed form solutions for the bond pricing formulas and be able to estimate the model by maximum likelihood using the Jocelyn, Singleton, and Sue method, which is relatively straightforward. And the final assumption that I'm going to make is that there are only two countries. So even though I look at multiple currencies, I'm going to be looking at two countries at the time. The domestic country is going to be the US, and then I'm going to have a different foreign country each time that I estimate the model. So I may have Australia and the US, or UK and the US, Japan and the US, and so forth. And I'm going to make an assumption that markets are complete. And the reason that I make this assumption is because if markets are complete, then if I get the stochastic discount factor or the pricing kernel in each yield curve, then complete markets mean that exchange rates should be modeled as the ratio of these two stochastic discount factors. Now, in future work, I'm going to be relaxing this assumption and allowing for markets not to be complete, but this is the model that gives me the simplest setup that I can think of to see how interest rate factors in two different countries can explain exchange rate movements between them. So I have three slides with some equations to show you what the model looks like. The first one is the set each country, each domestic and foreign country, it's going to have what we call the risk-free rate that is going to help us price bonds in each economy. And as you can see, the risk-free rate R is going to be a linear function of Y. And this Y here is my interest rate factors. So for example, the US risk-free rate is going to be a linear function of the US level, slope, and curvature from the yield curve. And for the UK's risk-free rate is going to be a function of the level, slope, and curvature of the UK yield curve, so UK's interest rate factors. And then row 0 and row 1 are parameters that I will be estimating from the model. Now, these factors evolve as a vector autoregressive process of order 1. What does this mean? It means that we know the factors move over time, and I'm going to have two sets of equations that are going to be describing how factors are moving over time. So as you can see here, these equations look identical. So we have that future factors depend on a constant that is going to be related to the unconditional mean of the factors. And then it depends on what the factors were the previous period. So this is the autoregressive nature of the factors. If you want to know what the factors will be tomorrow, you can just look at where the factors are today, and you know there will be plus or minus uncertainty around that number, but that's how factors move over time. They are persistent. Now, the closer this K1P plus I is to 1, then the more persistent and the more slow moving that factor will be, which means that the closer this number is to 1, the more the past will matter for determining where the factors go next. So you might be wondering, why do I have two equations that are the same? And the difference in these equations are the subscripts. So here we have P's and here we have Q's. Other than that, the equations are the same. And what this means is that the factors here are moving in what we call a physical or actual probability distribution. So this is an estimation of how the factors are moving without any restrictions. Whereas under risk neutrality, these parameters are also estimated, but they will have restrictions to account for risk. So we are looking at how the factors move in a risk-averse world and also in a risk-neutral world where investors have already taken into account the risk of movements in these factors because we don't really know what is going to happen to the yield curve. There is always some uncertainty that is going to be priced in. Now, what we get from modeling the way that factors move under two distributions is what's called the price of risk coefficients. So we call the difference between the K0s, we call them lambda zeros, and the differences between the K1s, we call them lambda 1. And that gives us this equation right here, which is called the market price of risk. And this is basically capturing that risk that investors are observing as the factors are moving over time. And as you can see, this is a function of the factors themselves. So the factors will be moving and the price of risk will be determined by the difference between the K0s and the differences between the K1s per unit of volatility. Okay, so this is what a standard term structure model is doing, is trying to understand how factors move and capturing the price of risk. And then it uses those prices of risk to come up with a formula for the stochastic discount factor. Now, the stochastic discount factor is the pricing mechanism that investors in each country develop in order to price all the assets in the economy. If you focus on finance and study bond markets or asset pricing in general, people in finance tend to call the stochastic discount factor the pricing kernel. So it's exactly the same. Now, if you're more of a macroeconomist and you look at different DSG models or Lucas type of economies, then you call this M intertemporal marginal rate of substitution. So we have this both in macro, we have this in like pure finance. All of these things are equivalent ways to think about this M function that in this case, because of the assumptions of the model, has this exponentially quadratic form. So I know it looks like a lot, but the only thing that I want you to take away from this M formula, this stochastic discount factor, is that it's a function of the risk-free rate, which was a function of the factors, and it's a function of the prices of risk, which is also a function of the factors. So even though we have a lot of things going on here, what's important is that this term structure model allows you to get a stochastic discount factor that is only a function of factors, my interest rate factors, and then parameters that get estimated in the model. And this is quite convenient because in macroeconomics, you need to make a lot of assumptions to get some estimates of the stochastic discount factor in terms of technology and preferences, and we don't need any of this. All I'm giving the model is yield curve factors or interest rate factors, and it's giving me this stochastic discount factor with this functional form. Now, this stochastic discount factor is going to allow me to price bonds in the economy. So this is the fundamental asset pricing equation that says that the price of an asset today depends on the expected future price of the asset in the future, adjusted for risk. And this risk adjustment is happening via the stochastic discount factor. Now, what is the takeaway or the final thing about this term structure model is that because of the inverse relationship between the price of a bond and the yield of the bond, we can model yield curve movements or yields of any maturity as a function of the factors. And this is what we are getting out of this. And A and B are parameters that again will be estimated by the model, and they'll have restrictions so that no arbitrage holds at any point in time. So this is my entire term structure model. I get to model yields as a function of my factors, and I get my stochastic discount factor to do that. And each country is going to get its own stochastic discount factor, its own yield curve, its own interest rate factors. I'm going to call the domestic market stochastic discount factor M, and then the foreign one is going to be M star. So this is my last set of equations in this presentation. But this is going to be a key one because it's the innovation in my paper. I'm going to have both M's. So the foreign countries, this could be Japan's stochastic discount factor versus the US stochastic discount factor. And if I assume complete markets because of this theory, that is what's supposed to determine exchange rate movements. So exchange rate movements are governed by the ratio of the stochastic discount factors. And because I have closed form solutions for these bond pricing formulas and the stochastic discount factor for each country, then with this assumption, I can model exchange rate movements in this setup. Now, what's interesting here is that even though the interest rate factors of each country will only influence like its own stochastic discount factor. So for example, UK's interest rate factors will only matter for that UKM or UK stochastic discount factor. And for the US, only US interest rate factors will matter for the pricing formulas. However, when we are looking at the British pound US dollar exchange rate, notice that that exchange rate is going to be influenced by both US and UK interest rate factors. So this is my extension of the model and the way that I'm going to be modeling exchange rate fluctuations. And notice that I'm going to be doing this for different horizons. That's why we have the case in there. So I'm going to be looking at movements in exchange rate like 1 month from today, 2 months, all the way to 1 year. Okay, so I have my model set up, and all the assumptions that I made were to make the model as simple as possible so that I can estimate it by maximum likelihood, and I'm going to look at all these countries. And what is the estimation period will be determined by the yield curve data availability. So for example, when I look at my Australia-US model, I'm going to have from 1983 to 2016. When I look at Canada, I'm going to have Canada and the US from 1990 to 2016, because remember that even though you see all these countries here, my model is a 2-country model. So every time you see a foreign country, we're going to look at the UK and the US, Sweden and the US. And these are all the sources from where I get all the yield curve information to estimate my interest rate factors. And then I use the model to get an estimation of all these parameters. So that's all I have. I just have interest rate factors from the yield curves, and then I estimate the parameters using maximum likelihood techniques as in Jocelyn, Singleton, and Su with a discrete time setup. So now let me show you some results. This is the yield curve fit for the United States relative to the UK model, which is the one that I'm going to show you first. Now, the data is in blue and the model is in red. And every square represents a different horizon for the yield. So the first one is the 3-month US yield. Then we have the 1 year and 3 year. And then on the bottom, we have the 5, 7, and 10-year yield. And if you're struggling to see where the blue line is, that's because the model does such a good job of modeling US yields that they're on top of it most of the time. So if we focus on the 1-year yield, you could see that towards 2015, there is some sort of deviation that the model is predicting interest rates slightly higher than the actual data. But as you can see, the model does an excellent job of modeling the yields of the United States and the UK, and it's going to be very good at modeling yields for all of these countries. Now, this is not super surprising because these models were built to model yield curves, and they do a fantastic job at it. Now, what we take away from this picture is like, just because I'm modeling yield curves of two countries at the same time, and I'm also modeling the exchange rates, that doesn't take away from the model's ability to fit the yields really, really well, which is important to know. Now let's look at the exchange rates, which is going to be the very difficult thing for the model to do because these models were not built originally to fit exchange rates. And this is the result for the UK US dollar. This is the exchange rate movements at the 1 month. This is the 1 month exchange rate change. This is the 3 month, 6 month, 8 month, 10th, and 12. I have like every single month, but I just show a couple months to give you an idea of the spectrum. And if we focus on the 1 and 3 month, you are going to see that the fit of the model is not as impressive as when we were fitting yield curves. So at the 1 month, we have quite a lot of variability with my red lines, which is my model, but there are many instances in which the data is moving and my model is not able to capture that movement. And if you study exchange rates, you know that understanding exchange rate movements at the short end is very, very difficult to do. So the first time that I ever looked into exchange rates, I was quite disappointed to know that my model couldn't fit 1 month exchange rates. I was back in the day in grad school looking at exchange rates for the first time, and my advisor told me, if you were able to model 1 month exchange rate movements better than this, you would be making a lot of money because that's extremely hard. So we know that there is a lot of noise in short-term fluctuations, and this is not unique to exchange rates. If you're trying to forecast the stock market, for example, you know that our models really struggle understanding very short-run fluctuations in the stock market. However, we have made a lot of progress in understanding long-term movements. So for equity markets, for example, the price dividend ratio is the best predictor of stock market in the long run. And the same happens for exchange rate. Notice that even though the fit of the model is not as good in the short end, as we go further and further into the future, we are able to average out the noise and focus more on the signal that is being extracted from the yield curves, and the fit of the model improves substantially. So if we focus on the 10 or 12 month fit, for example, we can see that the model is generating enough variation every time that exchange rate moves, and we see that the fit of the model is much better. So this was for the British pound US dollar exchange rate. And I'm going to show you some general results for other currencies as well. So this is the Australian dollar, Japanese yen, the Swedish currency, the UK again, Switzerland, Norway, and Canada, all relative to the US dollar. And what I'm plotting here is the R square. So if I run a regression of the data on my model, the R square is going to give me a measure of how close those two are from one another. So focusing on the UK again, you can see that the R square at the 1 month exchange rate horizon is below 20%, meaning that the model is not able to capture the majority of exchange rate movements. However, as we look at further horizons, the fit of the model improves, and we can see that these interest rate factors can account for more than 50% of exchange rate movements at the 1 year mark. Now, this pattern that we see is holds for all these currencies as well. Even though in the short end, the fit of the model is not that good, we see that the fit of the model improves substantially as we move further into different horizons. Now, you might ask, what are all these different lines? Well, the red line is the baseline model that I showed you, and then I looked at many robustness checks to see what if I account for bias in the estimates, what if I look at non-overlapping observations? What are my confidence intervals at the 90% level? Those are the gray bars. So I'm looking at many different robustness checks, and the results hold across all these different specifications. So when we look at asset prices, because of some of the econometric characteristics of the data, we want to be very careful and do a lot of robustness checks. Specifically, we want to account for potential correlation and heteroscedasticity in the error term and small sample bias. And I do that by adjusting my standard errors with New West or Hansen-Hodrek statistics. But I also look at non-overlapping observations, and I use a correction suggested by Bauer, Rudebush, and Wood to correct for this potential bias. So I look at this 3 different ways to account for this, and my results really hold, meaning that they're not being driven by the small sample bias or this persistence that we see in exchange rates. I also look at a different base. By that, I mean that all my currencies are relative to the US dollar, and I'm based in the US, so I'm always thinking about the US as the domestic country. But is there something weird or funky about the US? What if you use a different base? What if you look at the Japanese British pound exchange rate as opposed to the Japanese yen US dollar exchange rate? So I choose a different base, which is the UK, and my results get a little bit better than using the US dollar, but they are not too different, meaning that this holds for different currency pairs and is not unique to the US dollar. I also look at different sample periods. What about the 1980s or 1990s or during the zero lower bound? Are the results different? And the answer is no. So there's no particular period that is driving these results, which is something that sometimes we worry about when we get some econometric results. I also look at even longer horizons. Now, the negative thing about looking at longer horizons is that I lose a lot of observations, but I look up to 5 years and the results just keep getting better. So this idea that the interest rate factors are capturing valuable information about future exchange rate movements down the road holds for more horizons as well. And then I look at a lot of econometric statistics to assess the goodness of fit of the model. So I'm going to be looking at the difference between my model and the data, root mean square errors, absolute errors. I'm going to do some predictability test and all those kind of things that are in the paper, but we don't see any of these things influencing the results. Now, in the paper, I look at something called uncovered interest parity. I'm going to be looking at the risk premium that my model implies. And I also come up with portfolio strategies to invest in different currencies depending on their yield curve movements. And I find higher expected returns than a simple carry trade strategy. So this tells me that if you learn how to extract yield curve factors from countries' interest rates, you're getting valuable information that can help you build a new portfolio strategy to decide how to invest in the exchange rate market. But what I want to show you next is my out-of-sample forecasting results. So this is what I do. I estimate all the parameters of my model up to 2015 data. And then I'm going to look at the factors in 2015. I'm going to extract those factors, and I'm going to use my model to forecast what the exchange rate would be at different horizons. Then I do a rolling window. So I move 1 month, January 2016, and I get those factors that day, and I forecast exchange rates all the way to a year out. And I'm going to do this all the way to May of 2019. Now, how good are my forecast of the factors? Well, we need a benchmark to compare those. And I'm going to use a random walk, which is the benchmark of no predictability. The random walk is a very naive strategy to forecast that says, if you want to know what exchange rates are tomorrow or a year from now, just use the last value that you have available. And that's going to be the forecast of the random walk. And if you haven't done any work with forecasting, you're like, that's kind of not really impressive to just use the last value you have and use that as your forecast. But if you've been doing work, especially with exchange rates, you know that it is very, very difficult to have any model that can beat that forecast. That forecast is the standard of, you know, what can we do to forecast exchange rates? That's the best we have. Now, my model can beat that forecast. And you can see that here, I'm going to plot the root mean square error of my model relative to the random walk. So if that statistic is above 1, that means that the random walk is better because the error or the difference between the future data and the model is smaller. So anything above 1 means that my model loses. Anything below 1 means that my model is better and can beat the random walk. Now you can see that we have a very similar pattern for short forecast, short horizon forecast, like, you know, 1 month or 2 months, 3 or 4. My model is typically doing better than the random walk for some currencies, but not for all. However, for the 1 year forecast, my model does better than the random walk for every single currency. And these gains are very significant. So the Canadian US dollar forecast 1 year out is 10% better than the random walk. And then for these currencies is 45% better. So these gains are quite significant and they hold out of sample. I have one more final set of exercises that I want to show you that are more related to some future work that I'm doing. And this is just more an exercise to think about, you know, what happens to the exchange rate as the yield curves move. And I want to give you a very tangible example of how yield curve movements are actually going to influence the exchange rate. And there are two cool things that my model allows you to think about. First of all, my model says, don't just focus on what the Fed is doing or what the central bank is doing, because when they are moving interest rates, when the Fed is lowering interest rates, for example, they're just looking at the short end of the yield curve, and that's what they are controlling. But my model says, yes, the short end of the yield curve is going to matter, but so are all these other movements, whether the yield curve steepens or flattens, whether the belly of the yield curve gets more concave or flatter. Those things are also going to be influencing the exchange rate as well. So we need to look at all these movements. And the second thing that my model suggests is that, and I don't know if you've been trying to study, you know, what happens when the Fed raises interest rates, what happens to exchange rates? And the answer is not always the same. Sometimes we're going to see the exchange rate depreciate and sometimes it's going to appreciate. And you might feel like that's, you know, confusing, but my model suggests that this relationship between interest rates and exchange rates is nonlinear. What that means is, let's say that interest rates go up by 1% or 1 percentage point, then my model says, well, wait a minute. I mean, is not 1 percentage point relative to what? 1 percentage point increase in interest rates back in the 80s is really not that meaningful because interest rates were really high and they move around a lot. If you're talking about a 1 percentage point increase in interest rates right now, when interest rates have been at the zero lower bound and they have only increased by 1/4 of a percentage point increment every year, then 1 percentage point is a lot. So if you need to understand what is the impact of interest rate movements on the exchange rate, you really need to think about whether the interest rates are really low or really high, whether the slope is steeper or flat, because that's going to matter a lot. So nonlinearities are important. Now, this is kind of fitting for today because I'm going to show you the yield curve for the US. And this is for a specific date. This is October 31st of 2016. We know that interest rates that day were quite low for most maturities. This is the 3-month all the way to the 4-year. You see that it's below 2%. And then I'm going to show you what happened to the yield curves a month later. And this is when President Trump won the US election. We didn't know the results of 2016 in October 31st, but then in November, we already knew that Trump won the election. Some people saw it coming, some people didn't. And I say this is quite fitting because we had our 2020 elections yesterday, and we're still learning the results. And I think there's going to be a lot of movement on yield curves and equity markets and exchange rate markets as we learn who the winner of the election is. But what you can see is that yield curves, first of all, went up for all maturities, but also the yield curve steepened quite a bit. So we can see that the short end of the yield curve didn't go as high as the end of the yield curve, which increased a lot more. So if the yield curve steepens like this, what happens to the exchange rate? And also, the UK at the same time also saw a steepening of their yield curve. So let me show you that this model can give us an understanding of the relationship between the interest rate factors and the exchange rate. This model looks a little bit messy at first, but this is an exchange rate function. And it's a function of the slope of the US and the slope of the UK. So we have the slope of the US. This is where it was back in October. And then in November, the slope went up. So the slope moved towards the right. And then the UK, this is where the slope was. And again, it increased, so it moves towards the right. Now notice that the slope in the US moving up meant that the exchange rate, the US dollar, depreciated. This was like a downward pressure on the exchange rate. Whereas the UK's yield curve steepening was an upward pressure on the exchange rate. But this is not always the case. Notice how nonlinear this is. So this movement to the right in the US put downward pressure on the US exchange rate because the yield curve was very, very flat. And this is where we were. But what if we were here? What if the slope of the yield curve was a lot steeper and it steepens even more? Well, if that happens, then that movement towards the right would have actually caused an appreciation of the exchange rate. So what this shows us is that it's not just, oh, if the yield curve of the US steepens, we will see downward pressure on the exchange rate. That depends on how flat or steep that yield curve was to begin with. If it was really flat, that is going to have a downward pressure on the exchange rate. But if it's really steep, it's going to have an upward pressure on the exchange rate. This is only for the slope, but you know that the level and the curvature of the yield curve will also have influence on the exchange rate. So if we want to know what happens to the exchange rate, we have to look at the influence of all these 6 factors in total on the final pressure on the exchange rate. And with this, I'm going to conclude by saying that yes, interest rate factors can explain exchange rate fluctuations, and those are the level, slope, and curvature of a country's yield curve. We can see that about 50% of one-year exchange rate movements can be captured by these factors alone, and this is true in sample and also out of sample. We know that the fit of the model improves at longer horizons, which is consistent with research in other assets as well, and that nonlinearities are going to be governing this relationship. So it's not a simple, you know, the yield curve goes up and we see this effect on the exchange rate. It really depends on the shape of the yield curve to begin with. So thank you.
Thank you, Professor Yung, and thank you very much for this for the excellent paper. I thoroughly enjoyed it. And I must say that the out-of-sample forecasting result is very good. I mean, for exchange rate, it's amazingly good. So I have some questions. I don't know, something has probably happened, and some of the participants are not able to share their question in the Q&A. So I have received some of the questions in my email. I'll read them out to you. The first question is, do you think that you have taken countries like, say, Australia, Canada, Japan, Norway, Sweden, Switzerland, UK? Do you think that the relationship between interest rate and exchange rate, will it be different somewhat for emerging countries? Do you think the emerging countries behave differently? So what is your expectation?
I have done some work for emerging markets like Mexico, Indonesia, Brazil, and we do see that each country is going to have a slightly different relationship, but the interest rate factors for each country can explain most of their yield curve movements. Like this is true for developed economies, for emerging market economies, and we know that this relationship with the exchange rate is going to be non-linear, but the extent, the strength of that relationship is really going to depend on the country. Moreover, when we think about emerging markets, many of those do intervene in the exchange rate market. And that really complicates the analysis too, because we don't see, if interest rates go up this way, this is what happens to the exchange rate. We have that relationship, but also we have government intervention that is changing the outcome that we see. So what this model can help us see is like, okay, what if we don't have government intervention? What would be this relationship? And then we can compare that to what we actually see in the data to understand the impact of government intervention and how much it differs from like a free intervention relationship.
Thank you. The next question, it says, you have mentioned at some point that you have considered different sample periods. Have you considered for the same country different sub periods?
You mean looking at only the 80s versus the
Yeah, I mean,
2000s?
so what I think this question means is that, for example, I can see that for Australia, I've taken 83 to 2016. So I think what probably this question means is that, do you think that, during certain decades, maybe pre-2000 or maybe between 2000 to 2008, before the financial crisis, and post-2008, is there any, do you expect that there would be, different kind of behavior in those? I think what this question means is that, what I think in my interpretation is that, do you expect any structural breaks or regimes?
Hmm.
Does the behavior change during those between those breaks?
Absolutely. I mean, if you study bond markets, you know that they're behaving so different than before. They used to move a lot, they used to be a lot higher, and now we see this, compressed yields, and we see that yields, in the short end of the yield curve have been zero or close to zero for many countries for many years now, and stay there. And also the long end of the yield curve shifting down. So we definitely see structural breaks. And we definitely see this relationship changing over time. So what that tells me is that we might want to think about a time varying estimation. So can we make this estimation time varying? So instead of looking at the average, let's look at, just the average around a specific period and then move it over time and allow the model to get us different estimates for different sub periods so that we can capture that structural break.
Thank you. Thank you. The next question says, in shorter horizons, the R square is low and it increases over time as your horizon increases. So what are the explanations why the explanatory power is low in the shorter time horizons?
Yes, we have a lot of trouble in, financial economics, understanding short movements in asset prices. So if you follow the stock market and you try to predict what the stock market will be tomorrow, these models are just not really helpful. And there are many explanations of why this could happen. We know that investors overreact. As they are learning new information, they will be, making their investment choices and their decisions and allocating their wealth accordingly. But then they, sometimes they overreact. And new information comes along that tells us, oh, that wasn't that important. We see these corrections happening all the time. So the best answer that I have for this is that there is a lot of noise and a lot of things that we don't understand that are sort of like creating a lot of variation in the short run. But then as people learn, if you look at just the news a week from now, only the important stuff will remain and everything else sort of like disappears. So I think we're better at getting signals when we look at the long run as opposed to the short run because of all the noise that is sort of uncovering the true signals in our estimates.
Thank you. We have a question in the Q&A box. I don't see the name, but the question reads, is there any effect of overall global economy on the interest rate of any specific company? I think what it means is that interest rate for any particular country, maybe.
Is there any effect of overall global economy on the interest rate of any specific country? Oh, okay, this is a very good question because what I do right now is just say each country has their own interest rate factors, right? So if you're the US, you have your level, slope, and curvature. If you are the UK, you have your level, slope, and curvature. And I think what this participant is asking is like, we know that there is a lot of like global factors out there, right? So if we see, you know, really strong economic news from the US, we know that that's going to influence other countries' investment portfolios as well. So in my new extension, I'm actually looking at global factors and country-specific factors, which I think would address this comment. Because right now in this model, I'm not able to do that. I say, oh, each country has their own factors, which is not very realistic in the sense that we know that these factors are very related. So probably global forces or global factors are influencing the country as well. And we'll also have idiosyncratic or country-specific factors. And so, you know, if you think like a country like Argentina is going to be subject to, you know, global factors and how the developed economy is doing, how China is doing, because Argentina exports a lot of grains and commodities and soybeans to China. So that's going to definitely influence that. But then there's going to be specific things to Argentina that will only affect Argentina and not everybody else. So I think thinking about global versus local factors is where like the literature has been going into, and that's one of the things that I'm working as well.
I think this partially answers, you know, the next question, which asks, did you find any specific reaction to Brexit? You have mentioned, you know, the reaction to Trump's election in 2016. So anything around Brexit, another big global event that happened?
I didn't specifically look at Brexit, but we do know that the foreign exchange market changed dramatically. We saw, you know, if you remember when the results of the referendum were announced, we saw movements in many different asset markets, like the stock market and the central bank of England, like the Bank of England, immediately lowered interest rates to provide stimulus to the economy and try to counteract all the uncertainty that this brought. And exchange rates, the pound depreciated, and we see that this effect was quite permanent because it didn't go back to other previous levels, and we still see the effects and the downward pressure on the pound still captured in there. So understanding how much of this is priced on the yield curve of the UK and transmitted into the exchange rate, I think that's a very interesting question.
And I have another question which says, you have taken Norway, Sweden, and Switzerland, and 3 Nordic countries. So is there any regional similarity? So the Nordic countries that behave in a certain way, apart from, you know, Australia, Canada, Japan, or other countries, maybe UK?
Yes, I think especially Norway and Sweden, they are very related. So we talked about global versus country-specific factors. We could also think about regional factors and a Nordic country factor. Switzerland is quite different just because the Swiss franc has this connotation as a safe haven currency. So a lot of people look at investments in the Swiss franc as a very different alternative from a Norwegian or a Swedish type of investment. But yes, I think this, you know, we could think about global factors and regional factors. And if we look at the relationship between Norway's and Sweden's interest rate factors, we'll see that they're very highly correlated, suggesting that there's clearly a regional effect influencing the yield curves.
Thank you. Thank you so much. I don't think we have any other question. Um, I absolutely thoroughly enjoyed your presentation. I'm sure everyone who is present here, they have enjoyed it as well. I'm really looking forward to read the next version of this paper when the data is updated till 2020, because I mean, the COVID crisis and the whole global economy, it has been affected. So probably there will be some significant change in the results as well. Really looking forward to see that and what kind of impact this crisis might have had. Um, I think, do I have? Okay, I don't think I have any other questions. So if the attendees, the participants, they have any other question, you can type it in the Q&A box or in the chat box, and we'll take that.
Well, in the meantime, let me thank you for this invitation. It's my first Zoom webinar that I ever give, and I'm so grateful to have this opportunity to still, get to talk about research and listen to these questions and think about all these important topics during this time. So it's very exciting that the school is doing this global lecture series. And also I'm hoping to get you excited about exchange rate work as well, because I know that's how your research agenda started, and then you sort of moved away from exchange rates. So hopefully you're thinking about more exchange rate work in the future.
We have another question from Swaroop, one of our MBA students, and he asks, the rate change in US will have an inverse impact on India. Then what would be effect on US yield curve when cash flows from India to US through US companies established in India?
Yes, this is a good question, but it's a difficult question. I mean, we need to study the effect of cash flows. We know that, just thinking about the S&P 500, the stock market, equity markets here in the US, we know that because many of these big companies, either their sales, the majority of the sales come from places like India, or their headquarters there, or their manufacturing and production processes are in there. They're very subject to what's happening in other countries. And sometimes we see the stock market move, and it's really not related to US specific factors. They're more coming from abroad, and that's because of the global nature of firms' profits and cash flows. So it's not very clear that we can say what the effect will be. I think we need a model to think about this mechanisms.
Thank you, Professor Yung. Thank you very much for answering that question. And I think we don't have any other questions. So, I'd like to extend warm thank you from Jindal Global Business School on behalf of the Center for Research in Emerging Economics and our internationalization team who have organized this series. Thank you very much for coming and patiently answering all the questions from the participants. We cannot thank you enough. And I'm sure that you will remember this day for a very long time to come, because this is going to go down in history, this particular day. And once again, thank you very much. Thank you very, very much for coming, accepting our invitation. I mean, all of us as academics, we were supposed to be somewhere during the winter, some other place, talking in seminars and conference. Now that is not happening, it's our little effort, just to feel like everything is normal. We are we are talking research, albeit not face to face. And we hope that when things become normal, when this pandemic is over, we'll have the opportunity to host you in person in our campus. It's very close to Delhi, and we are really looking forward to that.
Absolutely. Well, thank you very much again, and thank you for your questions and your interest in research. It's always fun to talk about, what's happening in the markets. And today will be a crazy day. This next few days will be the ones to watch. So, hopefully you can now think about what's happening in the markets through the lens of the model. What would a model say? What's happening in the bond markets and the exchange rate at the same time. And I think that'll be a lot of fun this next few weeks.
Once again, thank you very much, Professor Yung. And with that, I will conclude the session. And thank you very much. And you have a great day and you have a great semester ahead.
You too. Thank you.
Thank you.